In this module, we'll take a look at the planning strategies and products that you might be using in working with your client to develop their risk management plan and implementing the insurance piece of it. By the end of this lesson, you should be able to describe numerous insurance products and strategies that could be used in helping your client improve their risk management plan. When you start to work on this component of the financial planning puzzle, you'll be looking at the client's private insurance and also their employee benefit packages. And you'll be looking at that in combination to see if the basics are covered, if there's any glaring problems, challenges, weaknesses, or vulnerabilities, and are there any gaps in each of these different areas of homeowners and auto, life insurance, health insurance, disability income insurance, long-term care, liability, and also, if it applies, business insurance. And of course, to see if your client's objectives are being met. Let's start by taking a look at life insurance. Now, the 5 major life insurance products are term life, and then the cash value policies: whole life, universal life, variable life, and variable universal. As you decide which of those products best meet the situation, you'll be looking at the client's benefit need, the duration of that need, and the ability to fund a premium. And that last one, the ability to fund a premium, will often dictate perhaps a blended strategy, where perhaps you are bringing in a combination of term and some type of cash value. Of course, again, you're taking a look at, in combination, individually owned policies and group life policies. Remember that if your client is leaning on that group life insurance, that's only there. It's term, and typically it's term, and it's only there for as long as your client is employed at that firm. In planning for that life insurance need, you can start to customize the policy with riders and also making sure certain options are in there. For example, convertibility, the ability to convert that term policy to a cash value policy within a stated amount of time without there being a need for medical examinations for insurability. A waiver of premium, so during times of disability, the premium is waived. Guaranteed purchase option, again, that right of the insured to purchase maybe additional amounts of life insurance at different periods or within a different period of time, and also an accelerated death benefit. Now, this is a different alternative to a viatical, and it can be very valuable. So you have a client who is in a terminal life situation, tapping those with accelerated death benefits can be a way to maintain some quality of lifestyle near the end, also to pay medical bills. So while you will start to see that already embedded in many of the new policies coming out, you might want to take a look to ensure it's there. And there may be other options or riders that you want to see if you can get into that policy for your client based on his or her individual need. You've learned in your core courses 3 approaches to determining how much life insurance will be needed. And these are certainly more analytical than just applying some type of multiple 7 times or 11 times annual earnings. And you certainly, I think, want to be using at least one, if not a couple of these approaches to justifying the need that you come up with. So you have the human life value approach, the needs approach, and the capital retention approach. Health, disability income, and long-term care are also important pieces of this puzzle, for no other reason that the amount of this money can be catastrophic. And when you take a look at this situation, realize again that you're going to be coordinating the different components that come into play. And that can be employer-provided group health and disability benefits, workers' compensation, social benefits, Social Security, disability insurance, Medicare, Medicaid, and of course self-insurance, those individual policies purchased by the client. So let's take a look at each one of these different areas. So when looking at healthcare insurance, you're going to collect the data because you need to understand what insurance is currently available to your client. Are they eligible for Medicare right now? Will they be eligible for Medicare at age 65? Are there employer-provided group health benefits provided? Are there carve-out plans for additional levels of coverage that maybe your client has or could get? For example, dental, vision. And of course, again, individually owned policies. Looking at all the areas of coverage, sources of coverage in combination. In working through this, your strategy is to make sure that the family is adequately covered. And in some cases, that may mean improving the current level of coverage, also making sure that there's a continuation of coverage in the event of a change of employment or some other situation. So improving coverage, if your client currently is relying on Medicare or is going to be moving into Medicare, a couple items you might consider in your strategy is, maybe we should pick up some Medigap insurance here. Pick one of those Medigap plans to supplement Part A and B of Medicare, because there's some gaps in there, as we know. It's based on the number of days. There's some co-insurance in there. There's some items that are not covered. And with Medigap, we can close those gaps, or at least the ones we think are most likely to be used. Medicare Part D prescription drug may be a very cost-effective strategy for improving the coverages. And again, by adding that Part D, by going through the process of seeing which drugs the clients are on now and looking at the provider's registry and working it out, that can be a great strategy for supplementing the current level of coverage. In some cases, you'll be taking a look at special insurance that might be needed, and one that comes to mind is travel insurance. We have clients who are traveling overseas. You need to make sure that they're covered for more than just some emergency care. Again, going back to the employee carve-out plans, are there some supplemental coverages that can be added in a cost-effective manner? We need to take a look at that. There may also be available additional employer health benefits through cafeteria and flexible spending accounts. And again, COBRA is there for continuation of coverage. Once there's an event, the employee dies or leaves employment. And also the idea of managing the premiums. And with health care, I think a couple of the things we can think about is, well, we can make contributions to health saving accounts. Now, this doesn't lower the premium, but effectively it does on an after-tax basis. And as you know, that's because you can make contributions to the HSA on a pre-tax or pre-gross income level, and that effectively lowers the amount of the premium because of the tax piece. And also the idea of maybe entering a high deductible plan for those who are self-insuring or going out and buying individual policies. Now, we know disability income insurance is incredibly important because of the high probability of your client being disabled, the inability to go out and earn that paycheck is quite high, and it's quite higher than dying prematurely. So what insurance, again, is currently available to the client? We'll take a look at, well, is there Social Security disability benefits available? Realizing, of course, that it is difficult to qualify for that. Is the employer providing disability benefits in the term of sick days, short-term or long-term group disability coverage? Is there workers' compensation in place, and what does that mean? And in most cases, you're going to see it there. Are there any individually owned disability income policies, typically long-term, to supplement maybe what the employer is providing? Or what other benefits or what other monies are there during this time that disability would kick in? Are there any veteran benefits, civil service benefits, Medicaid benefits, or even a sizable emergency funds to cover this period when income is disrupted? Thinking about the strategy for adding disability, we can think about managing the premiums and customizing the policy a little bit. We manage the premiums by moving these different factors in combination. What is the definition of disability? What's the benefit amount? So that idea of what percentage of pre-disability income will the benefit provide? Is that going to be 60%, 70%? How long will that benefit period be? And what is that elimination period, which we know is that form of sharing of risk? And in that elimination period, is it 60 days, 30 days, is it 120 days? The longer the period, obviously, the lower the premium amount. So those moving in combination allow you to work with your client to manage the premium at the same time trying to meet the need and the duration of the need. A couple things you can do in thinking about customizing the policy for your client. Perhaps adding a waiver of premium. Again, the premium is waived during that period of disability. A cost of living rider, which will keep that benefit amount at least up to pace with some measure of inflation, and adding the renewability feature to the policy. Long-term care is generally recommended for clients who are in that 50 to 65 range. Now, I've also heard arguments for earlier than that, but generally when you get here, it's a very serious conversation. And because of the potential level of costs for a long-term disability, long-term care is really a key component of the risk management strategy. Again, we can think about managing the premium, and we do that by thinking about, well, what services will be covered? Where will they be covered? At home? The benefit amount, the duration, and again, the elimination period. So you can think about moving those around to get a premium that your client can afford. And not only afford now, but to maintain those premium payments. You can customize the policy with some riders. A couple that come to mind are the shared care, where maybe, and that simply means that each spouse has a certain level of long-term care nest egg of funds, so to speak. And if it's not used by one, the other one can tap that. Inflation protection in that daily benefit amount. And again, a waiver of premium during the time that the person is in long-term care. Let's now move from the healthcare arena into the property and casualty. Now, with auto insurance, you know you'll be looking at a standard investment policy. And you have parts. The parts I want to talk about here are parts A, B, C, and D. So when looking at Part A, what is the current automobile policy in place? What's the amount of that liability coverage under Part A? Is it 25, 50, 25, or is it 250, 500, 100? You know what those numbers mean, but it's important to take a look at that. And it's important to take a look at that within the context of your client's situation, their financial situation, their future earning capacity situation, and also where they live. That's important. Living in Beverly Hills have this whole different implication for what those numbers might be than maybe living in rural Midwest or something. Part B, what amount of medical payments are prudent and cost effective? So that idea that medical payments for people in your car, what should that level be? $1,000, $500, $10,000. Usually this is pretty cost effective. And you think about the ease, that additional health benefit that you can buy through the auto policy here. Now, Part C gets into the area of uninsured motorists, and this can be really important. You need to take a look at the amount of coverage there, and also to examine whether or not Part C covers underinsured, that should say underinsured motorists, in addition to uninsured. And if it doesn't, then that's an important rider, because someone who's carrying a maximum level of liability of 25 in an accident which is going to cost 200,000, where's that other 200 going to come from? So looking at Part C and Part D, looking at the value of the insured's car, is it worth even insuring the insured's car? You can set those premiums higher, the deductibles higher. So the idea here is gather that data, understand the client's situation, what type of vehicles are they driving, where are they living, find out going through this, does that auto policy need to be increased, particularly in the area of liability. And there are several endorsements that can be added And some of those are, for example, miscellaneous type vehicle endorsements, dune buggies, motorcycles, items that are not covered under the standard policy, auto loan coverage, auto lease coverage, and in addition to that, other policies could be purchased to cover things like watercraft and aviation. So the idea is to make sure that you have comprehensive coverage in these areas. Moving into the homeowner policy, again, you're looking at the standard ISO types. And you studied these in your course 506, Risk Management and Insurance, and you're familiar with HO2, 3, 4, 5, 6, and 8. And certainly, you can always go back into your notes from the course to investigate this further. Now, what are some of the strategies I think about? Well, first of all, you might be moving. You might be upgrading from an HO2 to an HO3 or an HO3 to an HO5 because of the situation and for the additional coverages. And that's one strategy you need to take a look at. Also complying with the 80% rule, and that's that the home needs to be insured for at least 80% of the replacement costs. Otherwise, the settlement amount is affected. And look at your notes for what that means. Again, here, when we're talking about 80% of the replacement costs, that's of the structure. That has nothing to do with the fair market value of the property, or the property, which includes the structure and the land. You can customize with endorsements, and I think you want to be taking a look at this in certainly your case clients, but in all your clients. And that is the idea of inflation guards, building code upgrades, personal property replacement settlements, and scheduled personal property endorsements. And that's important, because we know with the underlying forms, there's limits on personal property. And those limits are small. And so taking a look at those scheduled personal property. In some cases, depending on where your client's located, there may be other special insurance forms that are needed. Is earthquake a potential catastrophic exposure? If so, earthquake insurance can be purchased. Is hurricane or floods a real risk? And in that case, again, going out and buying additional forms of insurance. Remember, we live in a very litigious society. And liability umbrella policies are highly recommended to supplement those underlying liability coverages that we get in auto and homeowners. When you think about the amount of the umbrella that you're going to recommend for your client, I think you need to consider, first of all, their net worth and also that future income potential. Because if there's a suit, they're looking, the judge will be looking at both of those items. And also that's a way to justify the amount of umbrella liability. You need to maintain the underlying coverages. And in some cases, there's certainly going to be minimums that they need to be there. And realize that our exposures are changing because there's a lot of internet, there can be slander, there can be malice online, and so there's a lot of different coverages you need to be taking a look at. And certainly, if you're not an insurance professional, when you get into some of these details, you really need to have the client, and perhaps you, sit down with that professional and make sure that the liability is completely covered and that you're not self-insuring. In other words, there aren't any gaps in that underlining policies of auto and homeowners before the umbrella kicks in. Also note that this applies to personal and businesses. So let's talk a moment for businesses. If your client has a closely held business, is a business owner, then you will most likely need to work with a commercial insurance professional, because all these same issues apply within that business setting. So there's going to be the P&C, which includes the liability. There's the need, for disability or death of the owner. What's going to happen to keep the business going? The key person insurance. And if your client is a professional, then you might get into the area of directors and officers liability insurance or E&O insurance. Particularly important for us as financial planners. In this presentation, we took a look at some of the strategies and products that you'll be used as you analyze your client's holistic risk management position, and ways that you can improve, supplement some of the existing policies to make sure that there's adequate coverage.